Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, May 30th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are another weak Treasury auction, sticky inflation in Europe, and improving growth in Europe. Market implications there are yesterday's weak auction of 7-year notes follows weak auctions of 2-year and 5-year notes this week and suggests the persistence of our resilient U.S. economy and sticky inflation themes are likely to continue weighing on investor demand for treasuries. Our Janet wants softer inflation theme represents a key headwind for asset markets heading into a multi-year high of coupon and bond supply in Q3. We do not believe fresh evidence of sticky inflation in Europe will cause the ECB to defy market expectations by not cutting at their June 6 meeting. We anticipate a continued outperformance of European equities over the short to medium term amid fresh evidence of our green shoots globally theme. Consensus has yet to fully acknowledge Europe's cyclical upturn. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one's regarding Q3 Treasury funding. The question reads, question is, at what interest rate does the private sector gobble up bonds? And at what rate does the government see a problem with too high interest rates / too low demand for bonds? Is that difference is to the government's detriment against its goals? That is bullish, scarce assets. I don't know if I understand that last sentence. Question continues, am I wrong? So let me unpack this in order. Says question is, at what interest rate does the private sector gobble up bonds? So the first part of that is, what we know is that, once we got to a little bit north of 5% on the 10-year nominal treasury yield and 2.5%, a little bit close to 2.6%, 2.6% on the 10-year TIPS yield, real treasury yield last fall, we saw a significant slowdown in inflation. We saw a significant slowdown in asset markets in terms of the correction we saw, deepening correction we saw on stocks and risk assets and widening of credit spreads. So that would seem, at least based on the most recent information we have available, that 5%, 2.5% is kind of that threshold for where the private sector sees value in gobbling up those securities because they understand what those levels are likely to do to the economy and asset markets. Step two here is, at what rate does the government see a problem with too high interest rates, too low demand for bonds? So I'm going to split the government into two parts here to answer this question. One with respect to the Federal Reserve and the second with respect to the Treasury. I'll start with the Treasury. There is no too high interest rate from the perspective of the Treasury, specifically the Treasury, and this is not the case for other sovereign debt issuers, but recall that the U.S. Treasury market is at the very center of the global capital structure. They're at the top of the global capital structure, at the very center of global capital markets. People, when they either are in treasuries or they sell treasuries to buy something else. Obviously T-bills represent the primary reserve asset, primary liquidity instrument for the broader investor community and really the global private sector. And so, there's really no issue from a rate perspective with respect to from the Treasury's perspective in terms of the level of interest rates, because they know the Treasury knows that it'll always be able to refinance these data obligations just based on how the system is currently set up. Now, there could be a significant shock to the system of which all hell would break loose from an economic and perhaps total war perspective if that were to change. But until that all hell breaks loose, total war, millions of deaths and all that kind of stuff that will take place, that has to take place in order for the Treasury to no longer be at the top of the global capital structure and for us to see that exorbitant privilege. Because again, we have the biggest guns and nukes in the world. We're not going to see that exorbitant privilege without a big fight. So you can assume, as an investor, comfortably assume that there's no level of interest rates that is an issue, because again, those bonds will get refinanced and rolled over, if only because there's 27 trillion of them outstanding from a marketable treasury debt perspective, and folks want their money back. So number two, breaking part that answer the second part of that question for the side of the Fed. The Fed is a lot more sensitive to cyclical economic risk, and I would argue just as, if not more, sensitive to market risk. So from the perspective of credit spreads, equity valuations, and volatility in and across asset markets. And so clearly we saw the Fed institute a very dovish pivot going back to last December partially in response to what we saw last summer. We do believe the Fed put us back that's part and parcel with our Jay wants a soft landing theme, is the Federal Reserve has essentially bent the knee to fiscal dominance in this post-COVID era, and is essentially saying, well, they're essentially allowing a structurally higher level of inflation. They have a de facto somewhere between 2.5–3% inflation target, at least according to our estimates, based on their inability, their lagged or their slow response, their slew-footed response to the level of inflation, and in fact that they're continuing to guide to policy rate cuts despite inflation not even being back to their quote unquote de jure 2% target. So the Fed is different from the side of the Treasury. The Fed's going to respond to a drawdown in asset markets and a slowdown in nominal GDP in response to interest rates getting too high, and based on the most recent market experience, which may not hold for future experience. Based on recent market experience, that level was about 5% nominal on the 10-year, 2.5% to 2.6% on a real basis. And then the second part of the question, I don't really understand. It's not worded very well, but I think I think we agree with the key takeaway is that you have to take a bullish long-term view with respect to asset markets, bullish view with respect to asset markets over the long term, because we have to understand that we are in a fourth turning regime. One of the key takeaways of being in a fourth turning regime from the perspective of an investor is that you should expect a significant, and I mean significant, increase in sovereign debt over the long term. And as a function of that significant increase in sovereign debt, you're probably going to see the Federal Reserve and commercial banks get financially repressed into supplying liquidity for that significant increase in sovereign debt over the long term. And as a function of that, you're probably going to see the prices of real assets and scarce assets, things like stocks, commodities, et cetera, Bitcoin, for instance, those types of the prices for those assets are likely to rise materially. But again, this is all just, this is investors escaping what is obviously going to be an inflationary, or it's not obviously, sorry, there's nothing certain about the future, what is highly likely to be an inflationary decade relative to previous fourth turning outcomes. So we did a big deep dive study on fourth turnings. That's in the appendix of all of our monthly macro scouting report presentations. If you guys want to go get some kind of unpack that analysis and look at and review the analysis there. So we'll wrap it up there. Darius Dale present. Oh, by the way, before I even wrap it up, I want to say that just because you have a structural bullish view on asset markets with respect to the long term does not mean the cycle ceases to exist. So you're going to need to manage risk along the way. The best way I can kind of draw this, and if I can draw this in a simple diagram before we wrap up, this is how we think about this from the perspective of scarce assets. Here's today, here's, I don't know, 10 years from today, and over the long term, the prices for these assets should go higher. But over, on a multi-month, multi-quarter time horizon, the market cycle will still cycle. And so there will be plenty of opportunities for somebody who has no idea how to manage risk to lose a significant chunk of their wealth because they are so glued to this upward sloping arrow in terms of the secular bull thesis and not paying attention to cyclical economic and market risk. And that's why 42 Macro makes the big bucks, because we are very good at helping investors understand where we are in these cyclical cycles, while also providing them with the thought leadership, global thought leadership, in understanding where that up arrow is headed over the long term. So you got to do both if you want to make money and save money in asset markets as an investor on a consistent basis. If you want to bury your head in the sand and be focused on some of these long-term debt sustainability dynamics and ultimately the policy response to that, be my guest. You're not gonna stay in a buy-side seat investing like that, because again, you're going to find yourself plenty of opportunities to blow up along the way when you're heading into a down cycle from the perspective of the economy, asset markets, or both. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, May 30th, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.